Are you a GEPF member considering retirement or resignation, but feeling uncertain about the potential tax consequences? Do you find yourself worrying about how much of your hard-earned money might be lost to taxes? Now, if so, you're not alone. For many, tax rules can seem like an intricate, confusing labyrinth, full of unexpected twists and turns. But gaining a clear understanding of these rules is essential as it directly impacts your financial future. Hi, I'm Devil Naika, a certified financial planner, and since 2004, I've been specializing in helping GEPF members decide whether it's better to retire or resign. Now, one of the critical aspects that we often navigate together is understanding the tax implications linked to both retirement and resignation. Now, today in this video, I'm going to be casting a light on the looming shadows of doubt, uncertainty, and fears that you have around tax. Now, I'll dissect for you using the 2023 tax rules, focusing on how they apply to your GEPF lump sum benefits. We'll cover everything that you need to know to optimize your tax benefits and minimize the tax liabilities. What's more, I'll also share with you a little known tax secret that could potentially save you up to 80% of your taxes. Yes, up to 80% of your taxes. Now, if you are determined to master your taxes and ensure that you are paying the absolute minimum, you won't want to miss what's coming up. So make sure you stay tuned until the end. Let's embark on the journey of understanding and mastering your GEPF tax obligations together. Now, I'm heading over to the iPad so I can give you the clarity that I want, right? And we're starting off with a rule, not a tax secret, because I'm assuming you might know this already. There are two ways in which you can work tax, right? It's either through tax evasion and tax avoidance, right? This is not the secret. I'm going to share with you the secret a little later in the video, but I want to give you this as a framework of understanding before we tackle both options, right? Now, in terms of tax evasion, this is illegal, okay? This is illegal. This is the one that's going to get you behind bars. It's going to be the one that's not going to make you sleep at night. What is evading? When you are evading tax, is basically you're not declaring, right? Maybe you are earning some other source of income. Maybe you're earning a rental income, or you're earning an income from some type of business, right? But basically, you're not telling SARS about a certain amount of income, or you're not declaring, you're not being honest. This is what tax evasion is all about, right? Tax avoidance, on the other hand, this is legal. It's legal, right? This is where you are having a look at the tax guide, trying to see what can you do so that you can adjust your financial situation in such a way that you're paying the least amount of tax, right? So it's legal. An example of this is if you have a retirement annuity. So if you have a retirement annuity, when you contribute towards that, you know that you are able to get a tax deduction, right? And that deduction obviously helps you then to pay less in tax. This is legal. It's legal to have a retirement annuity. So this is the framework I want to share with you. There are two types: tax evasion, tax avoidance, right? Everything that I'm doing with you today is going to be focusing on tax avoidance, right? It's the legal way in which you can manipulate your finances or adjust your finances so that you are legally paying the least amount of tax, right? Now let's go consider both options. We're going to look at retirement first, and then we'll head into resignation, right? So first up, we'll look at retirement. Now I want to get a member statement up so that we can analyze this carefully, right? I want to use the figures of that particular member statement so that you can see it. And also by me making use of this, it's going to put you in a position where you can run the tax calculation on your own, right? So you follow along using this member statement, and then you watch the video the second time around using your statement, and then you can do the tax calc, right? Critically important, you want to make sure that you're using the latest tax guide when you're doing this. So I'm using the 2023 tax guide. I'm bringing it up on the screen so that you'll be able to see. So let me pull this up for us now. There we go. Should be able to view this now. This is the 2023 tax guide. Notice it's here, 2023 tax guide. So when you are working with this, please make sure you're using the latest tax guide. Now, the member statement that I'm using will be this one. You can see it up on the screen here. Don't worry so much about the date, but I'm using this more so that I have the figures, right? Because I want to help you to do the tax calculation so that you can understand the differences between the two. These are the lump sums that are here. You can see a lump sum gratuity, a monthly income, and then we'll be working with the resignation value. So let's get back to the iPad to understand what happens on retirement, right? Now, what you want to bear in mind is when it comes to retirement, the benefits are pretty much fixed, right? It is predetermined, right? So GEPF is going to determine the lump sum gratuity. So they determine that gratuity. they also determine the income. Now, you can't really adjust this, right? So you can't go to GEPF to say, look, I want to take a smaller gratuity in order to save on tax. Or I don't need so much of income now, pay me a little lower income now because I want to save on tax. You cannot adjust it, right? Which means the tax on these elements must be paid, right? So for here, must be paid. You can't really adjust that, right? It's fixed. Let's use an example on the gratuity. You can see here on your gratuity benefit, I'll pull up the statement. The lump sum gratuity is sitting at 1.2 million, which means if we are doing the tax calculation on the 1.2 million, it will go as follows, right? I'm going to round the figure off to say 1,250,000, again, just to make the math look easy for us. So heading back onto the tax guide here, and this is the table that we're going to be working with, right? Now, there's a lot of fine print behind this, so it's critically important that you get proper advice. I'm not taking into account for this video pre-98 tax. I'm also not taking into account if you have a retirement annuity or any other vehicles that are aligned with tax, right? I'm just doing a straightforward, simple calculation to give you the understanding. So you notice here it says lump sum, retirement lump sum benefits or tax severance. What's changed is this used to be 500,000. It's now shifted, right? It's now moved up to 550,000. This is why I'm doing the latest video to help give you guidance on how to calculate it. And notice we said we're calculating on 1,250,000. So if you look at what's taking place here, 1,250,000, the gratuity, it's more than 550, more than 770, more than 1,155,000. So the leg that's going to apply here is the bottom end of this table, right? This is the one that they'll use. What SARS is saying is it's 143,550 plus 36% of whatever exceeds 1,155,000. So you want to think the way SARS thinks, right? So when I'm doing the calculation with you, I'm doing it the way SARS does the calculation so that we get to the same and correct answers, right? So again, you don't have to do it. You just follow along on the example. I pulled up a calculator here so that we can see it together. Now, we're looking at 1,250,000. I've rounded up the gratuity benefit, right? So that we get a more accurate figure. 1,250,000 minus 1,155,000, right? And the reason I'm doing this is the amount that is in excess, right, is what SARS wants at 36%. So this figure I'm multiplying by 36%. That gives us 34,200. But remember, in addition to that, there's 143,550 that SARS says we must add, right? Remember the leg of the formula. So in this instance, on that gratuity benefit, 177,750, right? So hope this one makes sense. Here's your gratuity. And we said that the gratuity benefit is 1,250,000, and the tax on this one is going to be 177,750. Pardon me, 750, right? Now, notice what I shared with you earlier. You can't really adjust the gratuity, right? So you can't take less in order to pay less tax. It's a fixed amount. It's predetermined by the trustees, right? Predetermined by GEPF as per the rules, right? So this is what happens in terms of retirement. Remember as well that the income is going to be taxable, but in this video, I'm just working on the lump sum tax, right? Now, what happens in the from a resignation perspective? I first want to explain to you the flow of money, right? And then the tax secret is going to come in shortly afterwards. So here's a pool of money. This is sitting with GEPF. This is where your money is right now, right? And there are only two options that are available if you are aiming at resigning. The first option is you could have the entire benefit taken out in cash, right? So you can say you want to withdraw everything in cash. We'll use that as an example in our calculation. So let's head back to the member statement. You can see it up on the screen. And notice the resignation benefit. I'm going to round the figure off just to make the math look easy for us, right? I'm going to make this resignation benefit to be 5.1 million. Again, just to make the calculation look a bit easy. Then we head back to the tax table that SARS has for us. Again, notice the 5.1 million is more than 550, more than 770, more than 1,155,000. Can you see it? Which means we're back on the same leg at the bottom here, right? Which is 143,550 plus 36% of whatever exceeds. So how we do the calculation? Again, I'll do it for you, and then you can do the calculation using your statement, right? Remember, I'm rounding the figure off. So 5.1 million, that's the resignation value. Then you want to minus, pardon me, 5.1 million. Then you want to minus 1,155,000. This is the difference. And this is the amount that SARS is saying, hey, they want to have 36% of it, right? Which means 1.4 million is the tax here. In addition to this, remember the 143,550. Right? So the total tax, let's assume that you were this member and you were drawing all this money in cash. Your total tax here is 1,563,750. Let's go back in. Tax secret's coming up, so make sure you stay tuned for it. So notice here, what's happening is, because you were drawing all that money in cash, the tax consequences is very severe. Now, you might already know this, which is great, but is it helpful knowing how to calculate the tax, right? And knowing how much tax would go in this instance, right? Now, here's the tax secret that I want to share with you. So in terms of money that's getting paid, right? Whatever gets paid into your bank account, so whatever's coming to your bank account, this money is going to be taxed. Right? So if it's coming to your bank account, that money is going to be taxed. Then whatever goes to the insurance company bank account, so it's different now, insurance company bank account, this money is not taxed. So remember this rule, right? I'll refer to it. And I promise you, once you apply this, you're going to be a tax boffin, right? You're going to see how easy it is to save on tax here, right? Now, we looked at one option, which is cashing out, and I said there are only two options available if you are resigning. The second option here is you can move your money into an approved fund. Please, I always say this in all the videos, you want to make sure that you're comparing the options for approved funds, right? So a preservation fund is not the only option that is available, and you definitely do not want to make a mistake in the beginning. You have to analyze the options carefully. Once you choose it, you cannot go back to change it. But whatever the approved fund is, once you move the money in there, notice what I shared with you earlier. Because the money is moving to the insurance company, right? And you're transferring all of the money across. Can you see that benefit is not taxed, right? You're moving everything from GEPF into the approved fund. The moment you do this, because everything is moving over, there's no tax. In essence, if you analyze this carefully, just that one move, right, saves you 1,563,000 in tax. Just that one move. Now, next up from there, you cannot sit inside the approved fund. And the reason for this is the approved fund is not designed to pay you an income. It's just a holding bay. It's just a temporary place to house your money, right? So you want to come away from the approved fund. And the reason for that is you want to access some of your money. Now, in terms of this, you can access 1/3 of this in cash, right? So you can access 1/3 of it in cash. Let's go analyze what this would be, right? Now I'm going to take the 5.1 million. Remember, that's the resignation value for this particular member. So you'll see it here, 5.1 million. And I'm dividing it by 3. And the reason I'm dividing it by 3 is that would give me the lump sum, right? The 1/3 lump sum. So 1.7 million is the amount that's sitting as a 1/3 value, right? So I'm going to head over to write that figure down, 1,700,000. Once we're here, I want you to analyze something, right? Notice that if a member, if this is you and you're aiming at retiring, right? You want to compare the lump sum that you are getting on resignation against the lump sum that you are getting on retirement. So notice the difference here, right? We saw the gratuity was sitting at 1,250,000. This is the gratuity lump sum if you opt to retire here for this, if you assuming you're this member. And on resignation, because you get entitled to the full 1/3 benefit, can you see the benefit significantly higher? Right? It's a lot higher. And I've shared this in previous videos. The reason for this is you can get a true 1/3 value here, right? Now, because it's a true 1/3 value and it's a higher amount, remember how our tax system works. The more you're taking, the more tax is going to get paid, right? Notice, where does this money get paid? Into your bank account, right? And because it's in your bank account, can you see that it's taxed? So let's go analyze this, right? Same calculation. We're going to head back over onto the tax guide. You see, again, it's sitting at the bottom here, 1.7 million, which means we're following the same leg of the calculator, right? As we're seeing here, the calculation. So I'll bring up a calculator so we can see it. So 1.7 million minus 1,155,000. This figure times 36%. Now that gives us a total of 196,200, right? But in addition to that, I've got to add 143,550. Now the total tax in this instance is 339,750, right? So tax 339,750. Now, if you just compare this, right, without analyzing the information carefully, you might be under the impression that, hey, you're losing a significant amount of tax if you have to resign, right? If you just compare the tax, 339 versus the tax we calculated here, 177, right? It's a big difference between the two. But you also have to bear in mind that if you are retiring, the gratuity is a lot less. And because the gratuity is less, the tax is naturally a lot less, right? But here's the secret again. Remember, doesn't have to be a 1/3 value. It's up to. So remember those two critical words, right? Up to 1/3. Meaning, let's assume that you're not taking the full 1/3 value, right? You're going to take the same amount here, 1,250,000, as opposed to taking the full 1.7 million. In that instance, your tax is going to be the same 177,000. But you could take this a step further. You could take an even lower amount, right? Because this is something that can be adjusted, right? This is the flexibility that resignation has to offer. So you could take a lower amount here because it's up to 1.7 million. If you're taking a lower amount, then naturally it would reduce your taxes, right? So if you have a look at the tax guide here, if you're taking 550, notice there's no tax. If you're taking 770, the tax is only going to be 18% of whatever is above the 550. If you're taking 1,155,000, you're still paying a low tax. So notice that you are able to adjust this, right? That tax is in your control. Now we'll head back. Let's go analyze the difference in terms of what happens with the 2/3 component, right? So your 2/3 component is going to sit here. 1/3 is taken out, and the 2/3 is in this element. Now, from a tax perspective, you're moving all this money to the insurance company, right? So you know it now. If all the money is moving into the insurance company bank account, can you see that there's no tax here? Everything's getting moved to the insurance company bank account. So in this instance, there's no tax. Now you want to be mindful that when the money is invested, you naturally are going to get some type of income from here, right? And that income is going to come into your bank account, just like you would get money in your bank account if you are retiring, right? You're going to earn an income and that comes to your bank account. Same here, you're earning an income. That income comes to your bank account, which means that money is taxed, right? But let's go analyze this carefully because I want to get rid of any concerns or fears that you may have around resignation and the tax consequences, right? If you look at the flow of money, how I've shared it with you here, you've got two options. You can take it out cash or you can move to an approved fund. Moving to an approved fund, every single thing is protected, right? All your money, every single cent is protected. There's no tax there. Obviously, provided you get the right guidance and the right information, right? The right advice to structure this. In terms of the 1/3 amount, you don't necessarily have to take a third. You can take less than a third. Taking less than a third means you are in a position to pay less tax, right? So again, gives you an advantage. Here, in terms of the 2/3 that's going in, every single cent is not going to be taxed because it's all moving to the insurance company. And there's 5 different income options that are available, right? For you here, you can view that in other videos. But in those options, there's one option that allows you to adjust your income, meaning you can increase it or decrease it. Again, if you're taking a lower income because you don't need it right now, that's okay. You can always take a higher income the following year. But by taking a lower income, you're then paying less tax, right? Now, there's tons of other tax secrets. I love tax. I hope you can see from the energy in this video. I absolutely love tax. There's countless ways in which you can adjust this to create the maximum tax savings, right? But what I'm sharing with you now is just the foundation. It's a critical secret that I want you to be mindful of. Whatever is getting paid to your bank account is going to be taxed. It's coming to you. Whatever moves to an insurance company is not taxed, right? So now you can have clarity in terms of the two options between retirement and then what I've shared with you here in terms of resignation and what resignation has to offer, right? So I hope this video has been insightful for you. Please post comments below and let me know, right? What are your thoughts in terms of this? How do you feel about your taxes now that you've watched the video to the end compared to before you started to watch the video, right? One last thing I want to recap with you from an income perspective, heading back onto the tax guide. Notice that the income is also on a sliding scale, right? So the more income you're going to take, as you move up the band, the more income you're going to take, the higher the tax, right? Now, there's, again, lots of different opportunities for you to create tax saving. One of the main challenges why members are not getting maximum tax saving, obviously, one is from an advice perspective, right? You need to make sure if you're not familiar with tax, you have to ensure that the financial advisor or GEPF specialist like myself is familiar with this, right? They understand tax and can look at your specific situation and identify ways in which they can save you on tax. The key here is you want to start the tax planning early. Notice, if this is where you are right now, and we'll say X, which is when you are retiring or resigning, right? You need to get the tax planning done early. If you're going to wait to the end and you end up paying a certain amount here in tax, that's it. I want you to see there was no planning done. And because there's no planning done, the result is you having to pay tax. But the only opportunity you have to save on tax has to start now, right? It has to start before you actually end up leaving. So again, I hope the video has been insightful. Give me a thumbs up so I know the information is helpful for you. Remember to pass this video along, right? Share it with your colleagues and friends. It's a free video. Let's empower the GEPF community so members can make more informed decisions. And I'll see you in the next video.